So we are good to go. So today is a very interesting session, and today is 9th November, Saturday, lovely morning. I'm presenting this from Bangalore at 10 a.m. in the morning. So I always like to talk stories, analogies when I explain markets, and today we'll be talking on some of the stories and then connect those stories with our markets. And I promise you, this is going to be a very interesting session for all of you. So I've titled this as Sachin, Markets, Elephant, and Golf. And let me tell you, all these three are not interlinked to each other, but all these three are always connected to markets. So with this, let me get started off. So we all know Sachin Tendulkar, and there were two eras in cricket. Cricket before 1990s when Sachin came, and cricket after 1990s. Cricket before 1990s was very dull, where people were just playing like an average batsman, and there were some successful batsmen like Kapil Dev, Sunil Gavaskar, and Don Bradman in Australia. Great respect for them. But Sachin came, and then he changed the course of cricket in terms of his batting. So we, according to me, there is one batsman called Sachin, and then there is rest of all. So there was one interview taken with Sachin Tendulkar, and then the person who was interviewing asked Sachin, "What is the what is that makes you different from other batsmen?" And then I would like to tell you, and this is what Sachin did, and then he told, "Now, can you see this ball and can you see this bat?" What Sachin used to do, he used to place this bat much before uh, the ball was placed, much before the ball was placed on the ground. So what were other batsmen doing? They were just placing the bat after the ball was pitched and then trying to score. What Sachin used to do, he used to place the bat anticipating that ball is going to come in that direction, and then he was already ready for the ball to be hit for a boundary or for whatever score that he had to score for that ball. That was the key differentiator between Sachin and other batsmen. Let me tell you one more thing. Assume that you want to shoot a rabbit, and you're holding a gun and there is a rabbit in front of you. What normally you would do, you're going to show, if you are being asked to shoot this rabbit, you're just going to point this rabbit on this yellow color circle which you're seeing on this rabbit. However, it is told that you have to shoot the rabbit not on its body but where it's going to jump, which means you actually have to think ahead, think much before others to make your things more successful. Now, taking this example from Sachin and from Rabbit, what is the takeaway that I believe in terms of investing is that when you're making your investments, you need to plan your investments one step ahead and maximize the growth, similar to how Sachin placed his bat before the ball was pitched. Today, no, we all know markets are at 80,000 levels, and some investors are chasing what did well in 2024 and which funds of mutual funds did in 2023 and 2022. So people are chasing mid caps, small caps, and other funds, other sectors which actually did well. But if you really have to make money in markets, you should not be investing in those funds which have already done well. But you should be putting your money where the returns will come in 2027, 2028, 2029. And that's the difference between an average investor and a great investor. So whenever you're putting your money, think that are you shooting that rabbit on its body or it's where you're going to where the rabbit is going to get jumped. When you're putting your money, think again, are you going to put your money where are you going to put your money where it has already been invested, you have good returns, or where you don't have great returns? Try to play a contrarian approach. You will definitely have better returns compared to others. So this is how I would say that this is how this is getting linked with Sachin and our markets. I'll take more questions later. So this is the advantage of staying one step ahead. Let me tell you one more story, and this is very interesting. And look at these events. So these are just real numbers. I have a younger brother, and his date of birth is 4th of December 1991. The day when he was born, Sensex was around 1,800 points. Now, somebody told my father that, you should be investing in markets. However, there's not great awareness at those times, so my father did not invest money into markets when he was born. So when he completed his schooling, that was in March 2007, Sensex came at around 13,000 levels. At his time of graduation, the Sensex had become 17,404 in March 2012. And at the time when he got married, that was in October 2016, the Sensex was around 27,000 level. And today, market is around 79,000, 80,000 levels. Now, what does this indicate to all of you? There's an absolute 40x returns in about 33 years. My younger brother is 33 years old. And if my father had put my money in December 1991, the money would have become 40x in about 33 years. If my father had put the money when my brother was born, he would have easily planned for my brother's higher education, which happened in 2012. He could have easily planned for his marriage, which happened in 2016. So this is how the markets have given returns over the last 40 years. In the last 40 years, it is up by 14,000 percentage points. And today it started at base of 100, and today it's around 80,000, close to 80,000 levels. What's the message for all of us? If you have a kid in your house, then you definitely know that you have to plan for that kid's schooling expenses, higher education expenses, his marriage expenses, so on and so forth. So if you have a kid, then why don't you actually start looking at investing in markets where you know that once when the kid turns 18, and if your kid is small today, 2, 3, 4, 5 years old, then over a decade and a half, 1.5 decade, definitely the markets is going to be higher than what levels are today. Take any example, all of you are attending here, look at your children, your brother, and look at Sensex on those dates when your brother, your daughter, your son was born, and look at today's Sensex level. I'm sure it has gone up. Keeping this in mind, the message for all of us is that if you have a child at home, start investing as long-term investment helps to harness market growth and overcome short-term volatility. I have written a book titled as Power Your Child's Financial Future. In my book, I have given similar examples that the best day to actually start investing for your child is the day when you realize that you have to make investment for your child. Because in the long term, all these things pays off. Okay? This is the power of long-term investing. Let me tell you one more story. So there was an this is a story from ancient India. So there's an elephant and there are six blind men. The story is called as an elephant and six blind men. And all the six blind men were asked to come near the elephant and asked to touch one part of the elephant. So you could see six men and one elephant here. One person touched the uh, uh, tusk of the elephant, and then he told it's a spear. You know what's a spear? It's an instrument to hunt animals. He told it's a spear. The second blind man touched its trunk, and then he said it's a snake. He was blind; he couldn't recognize these things, and he told it's a snake. The third person touched the ears of the elephant, and then he expressed that this is a fan. This is something. This is looking like a fan to me. The fourth person was touching the leg of the elephant, and he told it's a tree. I think it's a tree. The fifth person touched the stomach of the elephant, the body of the elephant, and he told it's a wall, it's a plain wall that I could see. And the last man who touched the rope of the elephant told that This is who touched the tail of the elephant told that this is a rope. Do you all think these blind men will right? Put me in your put something on the chat. Please tell me what happened to these blind men. Were they right or were they wrong? So I need some responses. So were these blind men right in their approach or were they wrong? So some of you are saying yes, some of you are saying no. Yes. Let me put one more story here. We have 6 experiences of people investing in stock market, and I'll again come back to this elephant once again. There are some set of investors who invest in markets and then they say it is very volatile. There are some investors who put money in market and then they feel there's an opportunity. There are some set of investors who invest in markets and when the market corrects, they say it's dangerous. Some investors who invest in markets and then they don't get returns, they say this market don't give any returns. Some investors put money in the markets, they enjoy a lot of thrill in the markets. And one set of investors who are not experienced, they say, I don't have any experience investing in markets. But but if you see this right hand graph, depending on when you invest, if you had invested in 2008 at the top, you would have seen danger. If you had if you had invested in 2011 and then seen again in 2013, you could have seen that there is no returns. If you had invested during COVID, COVID fall and again up, you would have experienced thrill. If you had invested post COVID in the last 6 months, you would have seen that market would have been lot of volatility would have been seen in the market. If you had seen this market in March 2020, you would have seen that there's a lot of opportunity. But if you're not invested, then you would have told that I don't have any experience. So, like these elephants, these six blind men in these elephants, think that this elephant is market, and these blind men are people like us who are investing in markets. So we all get different kind of experiences while investing. So hence, you need to look at the holistic perspective of markets and not only look from one angle. Like I said, somebody who invested on the day of COVID, March 3rd, 2020, he would think that there's a great place to make money. Whereas somebody who had invested before COVID and then saw during the COVID, he would have seen that there's so much of danger. I lost 20-30% of my money. But if you look holistically, if you look at the data from the year 2002 to the year to now 79,000 levels, in the last 23 years, market has given 15% return. Same wise, if you look at the whole elephant, you will not see that this is a spear, this is a snake, this is a fan, this is a wall, this is a tree, this is a rope. You will say that this is elephant. Same way, when you look markets from a very broader perspective, you will feel that this is an this is nothing but this is an economy of a country which gives me an opportunity to create wealth over a long period of time. So whenever you're putting money into markets, sometimes perception may always lead to misinterpretation. Market has given for 23% return in the last 15% in the last 23 years. But some investors always complain that I have lost money in the markets. But data is data. Data never goes wrong. If you look at this data, you see that market has given good returns. And if you look at the bottom side of this chart, the red bars, it says that each year market falls at a different levels. So whenever you see some corrections happening, please believe that that is more temporary in nature because the data says that Sensex falls on an average of 19% every year, and in every 3 years, it takes a higher level. This is what the data says from the last 23 years that every 3 years, market takes a new levels, new highs. So today, if you feel market is at 80,000 levels, then in the next 3-4 years, you will be seeing market going to a higher level. And from that year, if you look at the market, you will see that in the next 3 years, market is going to go much higher level. So we all should not be like these blind men. These people were blind and hence they were right in their perspective because they were blind, they can't see. But we are Human beings, we could see all these things. We could see, if we could analyze this data, then we could clearly tell that this is the place where we should be putting our money over a long. So that's the message here, that look in a very holistic way and don't look at a single year or a span of 2 3 years and make your judgment about investments. In the last 30 days, markets have fallen by about 8% each, and people see that people have started getting worried. But look at a long term perspective. I repeat this again. My final thoughts on golf. Okay, so what is golf? What did I put golf here? So what do you associate the word golf with? I would personally say golf means having a lot of time with you. To play golf, you need about 4 to 5 hours in a day to complete one round of golf, which says that you need a lot of time to play golf. Now, if you look at the perception here, that people who have crores and crores of rupees and doing multiple businesses, we feel that they are always busy, but most of the time they are found in golf courses. You see, rich investors, businessmen, industrialists, they go and play their golf almost thrice a week, twice a day. Some people do play their golf daily. Now, how do they do that? How do they play golf regularly at the same time manage their crores and crores of business? This is what I would like to tell you here and change your perspective here. So you all have invested in markets. You all have got good returns from the markets. Now, going forward, your portfolio will be growing in a huge number. Your portfolio is going to be 2x, 3x, 5x, 10x, 100x for some of you in the coming years. You may feel that you don't have time, you will not have time because you have other things to take care, you have portfolio to be taken care, you have your personal life, professional life, and other things to be balanced. Uh, Before that, I'm using this golf as an example and trying to communicate a story here. If you have not figured out how to balance your professional life, personal life, and other stuff, and you don't have time to play golf, which means you don't have time to pursue your other hobbies, then you should try to figure this out. I would say that you should try to figure this out, because if these people can play golf running crores and crores of business, and if they can find time to play golf, why can't you and others do this? One way to do this is One way to learn from these people is that these people do two things. They outsource a lot of things, they delegate a lot of things. If you see people at the top, all that matters is that they outsource a lot of things, they delegate a lot of things, and hence they create time for them to play golf. So, if you are busy with your own stuff, then I would give you some ideas that how should you find time. For example, if you're filing your tax returns on your own, then you should stop doing it. If you're doing investments on your own, then you should stop doing this. You should delegate it. If you're doing few things at home on your own, then I think you should stop doing it. Because every businessman, if you look, they have their own personal secretaries, their own chartered accountants, wealth managers, they have their advisors, they have so many people around them. They try to create time, and using that time, they actually put their time into business, and then once when the business goes up, they create wealth, and then they have a lot of time to play golf. At Happy Investor, we manage about 500 plus crores of assets, and we have about 600 clients. And we have a very small team of about 9 people. So new prospects keep asking us that how do you find time to actually manage 600 clients and 500 crores of assets, and how do you do that? We say that we have figured that out. We outsource a lot of things outside and retain the core responsibilities of wealth management of your money under us, and we have outsourced the tax filing part. We have outsourced the office maintenance part. We have outsourced whatever that we could outsource. We have outsourced this, and we only retain few things with us. And hence, we believe that in the coming years, if more clients like to join us, the previous clients would not get inconvenienced, and all the clients would be getting the same level of service, same quality of service, because we have figured out that we have to delegate things, we have to outsource a lot of things and retain what is in our capability, retain what is our strength, and outsource all the other things which doesn't matter much to us. So, in final thought is that if you keep doing everything for yourself, you may save some money, but you will miss out on a you will be missing out on a balanced life. If you're filing your own tax returns, then you may save about 3,000 rupees in a year, but you will miss out things on those things which will help you to keep your life balanced. The takeaway is that delegate to gain more time for yourself so that you can enjoy life moments without financial worries. So create time for a balanced life. That's the message. And the final thought on this, and the conclusion is that don't worry about Sensex. Every few years, it always moves up over a period of time. You have seen data. If you don't believe Indian Sensex, look at US economy in the last 150 years. US economy has given about 10% annualized return every year for 150 years. That's a good time frame. So every 3 years, the Sensex takes a new number, and every 1.5 year the Sensex falls, and then the average annual fall will be 19 percentage. If the market falls, don't worry. Avoid a blind approach towards investments. Think about elephant, think about those blind men, and please understand that those blind men were blind. They couldn't see the reality, but you could see the reality. You could see the data. You saw that the market has delivered 15% return over the last 23 years. You saw that market has its ups and downs, and then you have to stay invested in the markets. Set up systems that allow you to live life fully, and even have time to play golf. So basically, you are all doing your SIPs. So what actually that SIP is doing that magic for you is that you are actually not putting your time that this month where should I invest, which scheme should I invest. You're actually set up a system. So doing an SIP is something like playing golf. Like this, try to set up systems everywhere in your personal life, in your professional life, in your financial life, so that you have enough time to look at other things in your life. Thank you so much. And as I promised to keep this session short, I have kept this. And I'm happy to take few questions if you have. Thank you so much. I'm stopping my, I'll stop my screen sharing in few minutes. So if you have any questions, please feel free to ask. I hope you like this. All that I'm trying to do is that I'm trying to connect stories with analogies and try to give the message that investing in long term, don't get worried about the small ups and downs in life, and you will really make a lot of money in your life. You'll have a lot of time, and then you can enjoy your life. Thank you so much. Yeah,
Good morning, sir. It was a very wonderful session.
thank you,
I'm
thank you.
Vinod. Yeah, I'm Vinod here. So just wanted to understand.
Others can please unmute. Yes, Vinod.
Just wanted to understand the process of creating a portfolio and how often we do the review and what are the products that you offer for the clients, and what is the approach that you take for somebody who's like 35 years old and wants to build wealth for the next 10 years. I'm mostly interested in your process of onboarding clients, and then how often we do the review. And secondly, what are the products that you offer as a part of portfolio?
Okay, okay. So some of your questions can always be taken offline, but I'll tell you the core part. So your life is divided into three phases. The first phase, you're born, and then till you're 22, your parents take care of you. The second phase is from 22 and it ends at 55. And the third phase is 55, and then you end your life at some point in time in your life. So the first phase, your parents take care of your parents, your guardians take care of you. But the second and third phase, that's where the challenge comes. There are two phases, but you have only one, you have income only in one phase. So you need to start early. You need to start investing as early as possible that you could invest. Start investing the day when you realize that you're late, then you should start investing. So that the phase where you don't have money, which is 55 and beyond that, you create a regular source of income. So I suggest that you should start looking investing as early as possible. And the best, as I gave that example of Sensex giving and showing the chart of 20, 30 years. If you look markets in 20, 30 years, you get good, decent double-digit returns for a long period of time. So if you're looking to create wealth over a period of 20 years, then equity mutual funds is the best way to actually put your money and create wealth over a long period of time. Regarding our process, I'll take it offline because I would like to take other questions. So my colleague Pooja is also here. So you could leave your email here, and then we could get in touch with you. And or if you're connected with me on LinkedIn, then you could direct message me, and then I will take you. Okay?
Sure,
Thank
sure.
you.
Thank you.
Thank you. Yeah. Yeah. I see some questions on chat. Okay. Anybody have any other question apart from this? So Santosha is asking, wanted to understand investing in markets via shares and doing in mutual funds. Santosh says that direct investing in shares give more returns. Santosh, again, I say this is a perception. You saw that elephant. So direct investing is like that blind man touching one part and saying that this is how it is. But in reality, it is wrong. Okay, there are if there are 1,000 mutual fund investors who have created wealth, then there are only one person who has created wealth through equities. So if you are actually planning to make money through equities, then I think you should leave other jobs and only look into equities. Only then you will be able to create wealth for yourself. But equity, I mean direct stocks. But if you have a job in hand, if you have a family, if you have other things to take care, then you need to outsource your stock picking job to a professional body, that's through mutual funds, and that is how you actually have to create wealth for yourself. Personally, I would say this on record that I don't have a demat account at all. I never had a demat account, and I don't intend to have a demat account. All my money is invested in equity mutual funds, and that's the message. How do you plan exits for those who are nearing retirements? So it's when you are nearing retirements, then you really don't have to do any exit because retirement money will stay with you for about 30 years. There's nothing called as exit. For example, if you compare this with a child's education, for a child's education, you need all the money in 1 year or 3 years of that education phase of the child. But for retirement, you need to spend this money for about 30 years of your life. So you really don't have to do some exits at the time of retirement. If you are slightly higher side on the debt side when you are retiring, that's sufficient because you need to have a mix of equities, bonds, and hybrid funds in your retirement portfolio, and not only restrict only to bonds or debt funds in your portfolio. What if nearing child education market is done? How does when you do an annual review with your advisor, then your advisor will tell you that you need money in the next 24 months or 18 months or 12 months. Then whatever money you need for your child's education, that money has to be taken out of your equities and parked in debt funds. And through those debt funds, you actually have to make your safeguard your money and then not get don't have any issues with equity markets when they fall at that point in time. Yeah. Yeah. Any other questions? So we always promise, which is buying physical gold or gold bonds. Okay, the post this budget, buying gold via physical bond or gold bonds have same amount of taxation. So I believe that you should be buying gold more in paper form, that's e-gold, and not buying physical gold because physical gold have storage issues. They always have. You need to physically buy, store it, and place it in your home, and then safeguard it for a decade or so. Buying gold on paper will always help you. That nobody can steal that gold, and you will always have much better holding capacity when you actually buy a gold rather than a physical bond. How are debt funds better than FDs? In debt funds and FDs give you similar returns, but in debt funds you defer the taxation. So let's say if I invest 10 lakh rupees in a debt, 1 lakh rupees in a debt fund, and if I earn 7%, I don't have to pay tax on that 7% return on that 1 lakh rupees immediately this year. I only need to pay the tax when I'm going to sell it when I need it. But whereas in a fixed deposit, If I do a fixed deposit today, then all these fixed deposits are taxed in the same financial year, and then I need to pay the tax and then move on. So what happens in the next year? My gross returns minus my taxes. So the lower amount goes for compounding, whereas in a debt fund, the whole amount goes for compounding, and hence over a period of 10-15 years, when you look, you see the debt funds have given much better returns than a fixed deposit, even if the rates are rate of returns are similar. Yeah. So we always promise that, I think we are done with questions. We always promise happy investors known for punctuality. So we said that the sessions will start at 10 o'clock and end at 10:35. We actually accurately calculate how much time it's going to take now. The time is 10:33 and we are almost at the end of the session. And I'd like to thank all of you for being a part of this session. And for those of you who are attending live on YouTube, thank you so much for attending. And we'll be sharing the recordings of this session to all of you. Thank you so much. Keep attending. Me and my colleague Sujata keep doing this session once a month. We keep doing such sessions. Thank you so much. I love talking to all of you. I will stay in touch at different platforms. I'm connected on LinkedIn, Facebook. Some of you of our clients here. So thank you so much. Yeah.